Hello everyone. In this class we are going to look at the investment risk, and I am Dr. V. Uma Maheshwari, Associate Professor and Head, Department of MBA. Before we get into what is investment risk, let us understand what is investment. Investment is the process in which an investor uses the fund to buy different assets with the objective of earning regular income or for capital gains. So what is financial investment? When an investor is going to use the money to buy different financial assets for the purpose of earning income or capital appreciation. So we should know what and all make up the financial assets. From the slide you can see that there are different avenues that are available to an investor, like bonds and debentures, equity shares, mutual funds, bank deposits, post office savings. So there are gold, real estate. There are many avenues in which an investor uses the fund in buying the financial assets. And these financial assets are not the same. They differ in their characteristics. For instance, if you look at the money market instruments like commercial paper, certificate of deposits, they are very high in liquidity and their maturity period is also very short. But at the same time, if you go for investing your money in equity shares, you will have to take lots of risk, and the possibility of getting more return is also very high. Bonds and debentures give you very regular income, and their risk level is also moderate. So every financial asset has different characteristics. So let's dive into the investment risk. What is risk? Risk is the variability in return. What is variability? It is the volatility that you have with respect to the return that you are going to get from your investment. So how are we going to measure this volatility? We say that a particular financial asset is very risky when the chances of getting the return varies with respect to what an investor expects from the investment. So the variability around the expected return is said to be the investment risk. Now let's look at the different types of investment risk. There are two major categories of investment risk. One is the systematic risk, another is the unsystematic risk. What is systematic risk? Systematic risk is that risk which is common to all the financial assets in the financial market. It is not specific to a particular company or an industry, and you cannot avoid the systematic risk. These are all the characteristics of systematic risk. This systematic risk are further classified into the market risk, interest rate risk, purchasing power risk, and the foreign exchange risk. Let's understand each of these risks one by one. What is market risk? Market risk is that risk which affects the entire financial market, and this is to do with the movement of the market either upward or downward. Many of you would be very familiar with the terms bulls and bears with respect to the stock market. What is a bull phase? Bull phase is a phase where the stock market moves from the lowest point to the highest point, and it also moves from one highest to the next highest. And the bear is a scenario which is just the opposite of the bull. Here the market moves from the top position to the lowest position, and it also falls from the one lowest to the next lowest. This is the market risk, where the market moves in a particular direction. Why such a movement happens? It happens because of two important factors. One is the tangible events, another is the intangible events. What is a tangible event? Tangible events are the changes that happens in the economic scenario or the sociological factors or the economic factors. When these factors change, that brings a change in the financial market. What can happen, for instance, with respect to the economic factor, we can talk about the business cycle. Business cycle, we do have different phases in the business cycle, like the boom, we have the recession, we have depression, as well as recovery. Depending on the phase in which the particular economy is in, the financial market also reacts in the same way. When the economy is going to be in recession, you can expect a bearish trend in the market. So these are all tangible in nature. But you do have untangible events which has an impact over the market, like the investor's sentiment. It is not determined by the rational decision making process of the investor, but it is more to do with the emotions and the sentiments of the investor. For instance, when there is going to be a sudden outflow of funds by the foreign financial institutional investors, what happens? This creates a panic in the market. Even the Indian retail investors start pulling out the money from the stock market, just following the cues from the foreign institutional investors. So here, this is more to do with the panic mode than being rational. So the market risks are determined by both the tangible and the intangible events. Next, let's move on to the interest rate risk. Interest rate risk also falls under the systematic risk. This interest rate risk is for the bonds and debentures. And the bonds and debentures, we all know there is an inverse relationship between the price of the bond and the yield. What is the yield? Yield is the current market interest rate of that prevails in the bond market. Whenever the current market interest rate goes up, the price of the bond falls down. And it is vice versa. Whenever there is the current market interest rate goes down, the price of the bond goes up. So those bonds which have a higher coupon rate and those bonds which have a lesser maturity period are less affected by this interest rate risk. Next, let's move on to the purchasing power risk. Purchasing power risk is to do with the inflation. Inflation is a scenario where the prices of goods continuously increase, as a result of which the value of money keeps falling down. It happens because of two major reasons. One is due to the increase in the cost of production, which we call it as the cost push inflation. Another is to do with the increase in the demand for the goods and services, which is more than that of the supply, which we call it as demand pull inflation. How does this affect the investment? Whenever the inflation goes up, the real rate of return that the investor gets from the financial assets keep falling down. Next, we will move on to the foreign exchange risk. This foreign exchange rate risk happens when an investor is going to invest money in the foreign markets in other countries. So there is a risk when there is a time differential between the transaction and the settlement period. When there is going to be more difference between these two, the fluctuation in the exchange rate will affect the profitability from the investment, which we call it as the transaction risk. Another thing is the economy of other countries where the investor has made the investment. When there are going to be changes in that particular economy, that also affects the profitability from these investments, which we call it as economic risk. Let's move on to the unsystematic risk. Unsystematic risk is that risk which is specific to a particular company or which is specific to a particular sector. This unsystematic risk is very much avoidable. One can diversify the unsystematic risk. Why do we have this unsystematic risk? This unsystematic risk happens because of the managerial inefficiency, or it could be due to the labor problems, strikes and lockouts that a particular company faces. It can also happen when the company doesn't adapt itself to the technological environment, where they don't upgrade the technology in the production process. Sometimes it happens when the consumer preference for the goods and services that the company produces shifts completely, as a result of which the sales level goes down. So if you look at it, all these factors are specific to a particular sector or a company. It can also happen due to the faulty capital structure, and we all know the capital structure is to do with the equity and the debt component. When the debt equity component is not going to be correct, that results in problems, and that also affects the profitability of the company. So all these are said to be the reasons for the unsystematic risk. However, can we minimize these risks? Of course, we can minimize these risks by following certain strategies. We can do that. Yes, if an investor is going to create a portfolio with a varied investment, with a diversified portfolio, they can definitely reduce the risk, which will help them to have some kind of protection against the inflation. Similarly, an investor can go for investment with the short-term maturity. That will also help them in overcoming the purchasing power risk. And the interest rate risk to some extent can be minimized if one is going to invest in the bonds with higher coupon interest rate. The market risk can also be minimized by studying the price movements in the stock market, so that to some extent an investor can make a prediction about what kind of trend that they can expect in the financial market, whether it's going to be bull or bear. Accordingly, the investment decision can be made. And unsystematic risk can definitely be reduced by studying the fundamentals of the company, by looking at their strengths, weaknesses, by studying their financial statements. One can easily find out how strong the company is fundamentally, and the buying decision can be made accordingly. So one should understand that there is a direct relationship between risk and return. If an investor wants to have more return from the investment, then the investor should be ready to take risk. Only when an investor takes risk, the return that he or she can get from the investment can also be high, not otherwise. This you can see from this particular graph. You can see that the equity gives you the maximum return, but at the same time it also has the maximum risk. When you are going to make investments in the bank deposits, the risk is minimum, but at the same time the return is also very minimum, right? So next we are going to look at the risk measurement. How are we going to measure these risks? We can definitely measure the risk. We are going to do it by following certain statistical method. You can see from the slide, you have the ex post risk, ex ante risk, and the characteristic regression line. Ex post risk, here the risk is calculated using the past prices of a particular financial asset, and the standard deviation is calculated using the past prices, and the risk gets measured. If it is ex ante measure, here we do not have the past data, but we make prediction using the probability values, and again standard deviation would be and variance would be calculated using the probability values and the returns associated with each of the probability values, and the risk is measured. The last one what you see over there is our regression equation. Here the term that is used for measuring this risk is beta. Beta helps you to measure the systematic risk. What is beta? Beta brings about the relationship between the index and the individual stock. If a particular stock is going to have a beta value of more than 1, then one can understand that particular stock is highly volatile. If it is going to be less than 1, if the beta value is going to be less than 1 for a particular script, then we can understand that particular script is not that volatile. Risk, we need not worry about risk as such. Only thing, we should be in a position to assess the risk, and depending on the risk appetite, one has to choose the investment. Thank you everyone for listening.